Welcome to lecture number 19 of Cost and Management Accounting. Lecture number 16, 17, 18 may read it cost volume profit analysis. In lecture 19 and 20, we will study additional issues related to cost volume profit analysis. So before moving on to the additional issues, we will do a recap of what we did in 16, 17, and 18 so that you know what new concepts we'll be adding in these two lectures. Cost volume profit analysis is the study of effects of changes in costs and volumes on a company's profit. So what we do in cost volume profit analysis, we study the respective costs when it comes to the level of volume and the profit that we generate by incurring the costs at those volumes. That is why it is called cost volume profit analysis. It is also a critical factor in determining product mix, maximizing use of production facilities, and setting selling price, as we saw in 16, 17, and 18, and we will see again in lecture 19 and 20. Basic concepts. Because CVP is so important for decision making, management often wants this information reported in a CVP income statement format for internal use. The CVP income statement classifies costs as variable or fixed and computes a contribution margin. Contribution margin is the amount of revenue remaining after deducting variable costs. It is often stated both as a total amount and on a per unit basis. So this is the CVP income statement for Vargo Video Company. At the sales level of 1,600 units, the total revenue is $800,000 and the variable cost is $480,000. So when you subtract variable costs from the total revenue, you always get the contribution margin. And contribution margin is the remaining amount, which has to take care of the fixed costs associated with the production, and then also the profit that you aim to earn from your business. That is why it is called contribution margin. And when we talk about the per unit CVP income statement, so the sale price per unit is 500 and the variable cost per unit is 300. So contribution margin per unit is $200. Companies often prepare detailed CVP income statements. The CVP income statement in illustration 19.2 uses the same base information as that presented in 19.1, but provides more detailed information using assumed data. Now, this is the detailed CVP income statement. So, in the beginning, you always have the sales figure, and you also mention it in per unit terms. Then we take care of the variable cost. We list all the variable costs, and using these costs, we can calculate the contribution margin. So this is COGS. This is the variable part of the cost of goods sold. Then you have selling expenses and administrative expenses. So the total variable expenses is 480,000. From this, you get the contribution margin. And when you subtract the fixed part of the total cost. So, for example, the fixed part of the cost of goods sold is 120,000. Then you have the selling expenses fixed part, then administrative, and this way you get the net income. So this is the detailed format for the CVP income statement. Before we introduce additional issues of CVP analysis, let's review some of the basic concepts that you learned in chapter 18, specifically break-even analysis, target net income, and margin of safety. So as you would remember, Vargo Video CVP income statement shows that total contribution margin, which is Sales minus variable expenses is 320,000, and the company's contribution margin per unit is 200. Recall that contribution margin can also be expressed in the form of contribution margin ratio. Contribution margin, which how do you calculate the contribution margin ratio? By dividing the contribution margin by sales, which in the case of Vargo is 40%, as the contribution margin is 500 minus 300, which is 200, divided by 500, which is the selling price per unit. Illustration 19.3 demonstrates how to compute Vargo's break-even point in units using contribution margin per unit. So when you are calculating the break-even point in form of units, you divide the fixed cost, which is 200,000, divided by the contribution margin per unit, which is 200. So you get the break-even point in units. And if you want to calculate the break-even point in dollars, so you divide the fixed cost by the contribution margin ratio. And how do you calculate the contribution margin ratio? By dividing the contribution margin by selling price. So this is your break-even point in dollars. When a company is in early stages of operation, its primary goal is to break even. Failure to break even will lead eventually to financial failure. So why is any fresh company's primary goal is to break even? Because at the break even point, you are not incurring any losses, though you're also not earning any profit. Target net income. Once a company achieves a break even, it then sets a sales goal that will generate a target net income. So target net income is the targeted level of income that you intend to earn. For example, assume that Vargo's management has a target net income of $250,000. Illustration 19.5 shows the required sales in units to achieve its target net income. So as you know, your fixed cost is $200,000 and your target net income means the net income, the profit that you will earn after taking care of all your expenses is 250,000, and you add these two and divide it by the contribution margin per unit, which is 200, which again is calculated by subtracting 300, which is the total variable cost per unit from selling price, which is 500. So you get the required sales in units, which is 2,250 units. What does it mean? It means that you have to sell 2,250 units in order to earn an income of $250,000. Illustration 19.6 uses the contribution margin issue to compute the required sales in dollars. So this was the required sales in unit. Now we will calculate required sales in dollars. We know the fixed cost, we know the target net income. When we divide it by the contribution margin ratio, we get the required sales in dollars. So if you do a sales of $1.125 million, you will earn a profit of $250,000 on it. In order to achieve net income of itna, Vargo has to sell 2250 camcorders for a total price of 1.125 million. Margin of safety. Another measure managers use to assess profitability is the margin of safety. The margin of safety tells us how far sales can drop before the company will be operating at a loss. Managers like to have a sense of how much cushion they have between their current situation and operating at a loss. So this that gap between the current situation and the point at which you will start operating at loss is called the margin of safety. This can be expressed in dollars or as a ratio. As we saw in illustration 19.2, Vargo reported sales of $800,000. At that sales level, its margin of safety in dollars and as a ratio are as follows. So we know the expected actual sale is $800,000. Sorry for the interruption. We will again move on to Sorry for the interruption. We will resume our lecture. So at when the actual sales is $800,000 and the break-even sales, as you know, is $500,000. So you have the margin of $15, which is $300,000. Then again, if you want to calculate the margin of safety ratio, it is margin of $15, which is $300,000 divided by actual sales, which you know is $800,000. So you get the margin of safety ratio. CVP and changes in the business environment. Now we look at three different cases, and using these cases, we will look at the importance of CVP and the implementation of CVP when you are running a business. So we know the data, which is unit selling price is $500, the variable cost $300, total fixed cost is $200,000, and break-even sales we know is $500,000 worth of sale or 1,000 units. Case one: a competitor is offering a 10% discount on the selling price of its camcorders. Management must decide whether to offer a similar discount. So, what effect will a 10% discount on selling price have on the break-even point for camcorders? So we know a 10% discount, when we offer the customer a 10% discount, we will end up lowering the selling price, which will come to $450 per unit. Variable cost per unit remain unchanged at 300. Thus, the contribution margin per unit is 150, because it is 450 minus 300, which comes to $150. So that is the new contribution margin per unit. Assuming no change in fixed cost, break-even sales are 1,333 units. Why? Because you always divide the total fixed cost, which is 200,000, by the contribution margin per unit, which is 150, the new contribution margin per unit figure. So you get the break-even in units. For Vargo Video, this change requires monthly sales to increase by 333 units in order to break even. In reaching a conclusion about offering a 10% discount to customers, management must determine how likely it is to achieve the increased sales. So this is case number one. Now we move on to case number two. To meet the threat of foreign competition, management invests in new robotic equipment that will lower the amount of direct labor required to make camcorders. The company estimates that total fixed cost will increase 30% and the variable cost per unit will decrease 30%. So in the first part, you have to increase the fixed cost by 30%, and then you have to decrease the variable cost per unit by 30%. Total fixed cost becomes 260,000 because there's an increase of 30%. The variable cost per unit becomes 210 because there's a decrease of 30% per unit. The new break-even point is approximately 897 units computed as shown below. You divide the fixed cost by the new contribution margin per unit and you get the break-even sales in form of units. These changes appear to be advantageous for Vargo Video. The break-even point is reduced by approximately 10% or 100 units. Case 3. Vargo, principal supplier of raw materials, has just announced a new price. The higher cost is expected to increase the variable cost of camcorders by 25 per unit. Management decides to hold the line on the selling price of the camcorders. It plans a cost-cutting program that will save 17,500 in fixed cost per month. So you can see there's a reduction in the fixed cost, which is $17,500. Vargo is currently realizing monthly net income of 80,000 on the sales of 1,400. So they have told us the net income at which Vargo is operating right now, and the increase in the variable cost will be $25 per unit. So there will be an increase in the variable cost per unit, a decrease in the fixed cost, and we know the current net income level at which the company is operating right now. So the variable cost per unit increases to 325, fixed costs are reduced to 180 to 500. Because of the change in variable cost, the contribution margin per unit becomes 175, selling price minus total variable cost. The required number of units sold to achieve the target net income is computed as below. So now we have the new fixed cost figure as well, and we add the net income divided by contribution margin per unit, we get the required sales in units. So these are the three scenarios which give us a very clear picture of how we use CVP analysis in order to operate, and in order to produce, and in order to sell. So this is the end of lecture number 19. In lecture number 20, we will do the additional topics related to CVP analysis.